Welcome to the Retirement Income Store's educational video on required minimum distributions, or RMDs. I'm Sam McElroy, Chief Executive Officer of Stride Financial, a retirement income store in Chicago, Illinois. As everyone knows, the government wants to help us save for retirement. That's why they let us grow our retirement savings tax deferred during our working years. However, the government also wants us to use this money during retirement instead of saving it and never spending it. That's why once you reach age 72 and every year after that, the IRS requires you to convert a certain percentage of that savings into annual taxable income in the form of required minimum distributions. RMDs are the minimum amount the IRS requires you to withdraw from your retirement accounts each year, whether you need the money or not. As of 2020, you must begin taking your RMDs from IRAs, SEP IRAs, or other qualified accounts by April 1st of the year after you've turned 72. Now, to make it simple, most people take their first distribution in the year in which they reach the required age, and then one every year after that. One exception, however, is if you're still employed at age 72 at a business that you don't own. If that's the case, you don't have to take RMDs on that retirement plan, although you do still have to take them on any other qualified accounts that you may own. Now that we've covered some of the basics of RMDs, let's consider a question that I'm sure many of you are wondering. How much will your required minimum distributions be? To start with, your first RMD equals roughly about 3.7% of your IRA balance, then increases every year as you get older and your life expectancy gets shorter. You can calculate the increase each year by using IRS Publication 590 on the irs.gov website. It gives you a uniform table with a government assumed life expectancy for each age past 70. Simply take the balance of your IRAs on December 31st of the previous year and divide it by this life expectancy figure. It might sound simple, but there are some complications that can arise depending on your situation. For example, there is a separate formula for IRA owners whose spouses are more than 10 years younger, and usually their RMDs end up being a little less. Another complication is if you have IRAs and other qualified plans such as 401ks, 403bs, 457s. If that's the case, the RMDs from the IRA and each of the other plans must be calculated separately. They can't be commingled. This is one of the main reasons why many people will roll over their qualified plans into IRAs before they have to start taking RMDs. It just makes things a lot simpler. It's very important to make sure you calculate your RMDs correctly, because the penalty for not taking sufficient distributions is a whopping 50%. As for how much additional tax liability you'll have because of your RMDs, that also depends on a variety of factors, including your marginal tax bracket. Whatever your situation may be, the most important thing to consider when it comes to RMDs is whether you have the right asset allocation to satisfy them. Ideally, the asset allocation geared towards taking RMDs should be able to generate at least 3.7% or more in dividends or interest. If you're earning less than 3.7% annually, it could possibly mean that you could end up having to sell shares of your investment each year to satisfy your RMDs. This strategy can lead to disaster because it puts you at risk of spending down your principal and ultimately cannibalizing your retirement savings. A financial advisor who specializes in strategies designed to help protect your principal and generate reliable income through interest and dividends can help you avoid this mistake. If you need any help finding an advisor who specializes in retirement income, visit theretirementincomestore.com to find an income specialist near you. And if you enjoyed watching this video, make sure to watch the others in our educational video series.